So this is a message that's not going to be going away. But I am actually, if you have critical feedback, I love critical feedback over anything in agreement, really. So I've been talking about this in my quarterly letters, but people like to talk about a private equity approach to public markets or a venture capital approach, and I call it, and it's not even a family approach, it's really what I call it sort of a builder's approach to public markets. And what do I mean by this is that there's common attributes between families, founders, and even some good venture capital and private equity. And as the US election has demonstrated, and Brexit has demonstrated, and every election has demonstrated, we cannot assume an automatic recurrence of the past. It is always built. And one of my personal heroes, that was his quote, of course. And if you want a career outperformance, even being cut short in your youth of 60x, you have to do things a little bit differently. Everyone thinks that Sergio was an incredible capital allocator, and yes, he was, but what actually drove that 60x was an incredibly passionate leader. He spent 3 months of his year talking to 3,000 to 4,000 employees within the organizations, building their careers. He was being criticized as a deal maker. He actually didn't really do any deals at the end of the day, and he still did the 60x. He believed in people, and he did things completely differently from anything else. But in this room, it is quite appropriate that we talk about capital allocation. Capital allocation drives our alpha. That drives our short-term performance. My friend Will Thorndike wrote The Outsiders, and it was an incredible service because so many people, as we've seen in this room and we've heard with some of the activists, not too many people actually think about capital allocation, not enough. But it actually, let's not kid ourselves. So it is the rise on death trade for alpha. Capital allocation does not create any value at the end of the day. We are moving piles of money from one end to the other. And if you're a long-term investor, you should actually really focus about value creation. So if you think about creation for a little bit, it is elegant, but it's really messy. It requires patience. It compounds. It then transforms. And I believe creation is almost the same as building. Creation is our purpose. Here's my love of my life, and it's our urge to procreate is probably even stronger than that of eating or going to sleep, which is probably really important as well. Speaking of early humans, the Stanford marshmallow experiment is actually the #1 predictor of success in early kids, and so basically the ability to wait for that second marshmallow correlates to being smarter, healthier, prettier, and happier. It's almost everything you need. And so what I'd like to pose to you is actually the deferred gratification almost directly coincides also with the builders. They're the waiters. And unfortunately, and I think I'm preaching to the choir in the room, but I don't think that many of you guys are here. But unfortunately, most of our peers are bingers. And the average holding period, of course, has dropped to about half a year. I am in a lot of 3-on-1 presentations or management interviews, and I can't stand when I hear this, and it's almost embarrassing on behalf of our trade. But this is a common question that I hear all the time. Can you please take me through the news flow over the next 4 weeks? And the CEO that has to think about his 4-year plan has to deal with this unbelievable game. It has actually become an epidemic. So 78% of managers will admit to smoothing earnings. 55 to 60% would delay or cancel projects if it were going to hit quarterly earnings. And we're seeing actually right now what decades of beating the quarter does. The unwind is incredibly painful from the Jack Welch, almost Madoff-like consistency of beating the quarter. And so if we juxtapose a quarterly guider versus a builder, we can see some common attributes, or some opposite attributes, actually. Sergio is more volatile, but he's more durable and he's a better performer. And actually, you don't have to take my word for it. McKinsey Global Institute has shown what quarterly guiders do versus the long-term companies. And yes, earnings grow, economic value grows more reliably, but they are more volatile. Actually, in the financial crisis, all these longer-term thinkers, they suffered heavier market declines than their peers. But if you're a company, how do you actually guard against this short-termism pervading Wall Street? Well, you either don't go public, you stay private and Mossabise your company, and creates incredible distortions in the private markets. And unfortunately, this is coming at the same time when actually hedge funds continue to go up, and unfortunately I didn't have time to update that data, but they're still going up. Mutual funds have stagnated, but now active managers are competing against robots. And so it's the worst competitive dynamic I could actually think of. Less targets, more competition. And it's our fault. Quarterly profit maximization is ruining companies, and it's ruining active investment management. And I think we need to be a better partner for our businesses. So there's been two approaches. US companies have either stayed private or been led by a founder with dual share classes, which has a dirty word, which is I'm going to probably help disprove. Or European companies just stay private or they have a family or government controlling them. And everyone thinks about FANGs as being these founder-led companies and these amazing high-quality businesses that everyone wants to buy at 40 times EBITDA or wherever we are. But Europe has produced a significant amount of consistent value creators. And the interesting dichotomy is that in the US, there's more limited opportunities, more competition. In Europe, there are more opportunities, less competition. Fewer people want to look at pigs, particularly. So you get some distressed valuations, and actually you have better growth. This is, but before we leave Sergio, you can tie a builder basically to the amount of skin. I'm not going to move the people on this slide at all. And the career stock performance correlates almost perfectly to the auto ownership. It all ties to how much skin you have in the game. So I'm going to give you guys a preview of a white paper I'm working on with my friend at O'Shaughnessy. He's a factor investor. He's one of the robots that's killing our industry. You can look at this is the last 20 years. Exor did a similar study, so I just used their same holding period. And so owner-operators significantly outperform the market, over 2x. And actually, dual-class share structures outperform by almost the same amount. These are remarkably consistent. There's actually limited overlap between these groups. And so if you look at the long-term results, it almost starts to look like a Berkshire Hathaway chart. And there's 500 companies in these sample sets. This is not actually just a fluke. No, so there's the limited there's more owner-operators that overlap into the dual class, but limited vice versa. And when you combine the two, dual class and owner-operators, you get a significant boost to the incremental outperformance. Now, this is really interesting. We seem to be at the end of the cycle. Everyone keeps calling for this in a macro way. Owner-operators and builders actually underperform at the tops of the markets. Why? They're not doing the stupid things that all their peers are doing to get their stock price up. They're not buying back stock at the top. I wouldn't mind Exor buying back stock right now, but they're not. They're not doing stupid acquisitions. They're not doing whatever they can just to get the stock price up because that's what Carl Icahn wants them to do. And so actually, it's a pretty good time right now because they will, just like Buffett did, not just like Buffett, they will outperform significantly throughout the downturn if we have one. And really interestingly, there's no valuation premium in owner-operators or the dual-class companies. They're trading at a discount to the market. It's only a very slight discount, but I don't really care. When you can get higher quality at the same price, if not better, I'll take that any day. Now, this is really interesting. The Europeans have outperformed the Americans. We're still studying why, but it's 3, 5, 10, 15 years. The Europeans are outperforming the Americans. And the Americans actually include FANG, which is pretty amazing. Let's see. We've got, here's one of the biggest, actually CapEx and R&D are not very different between the two groups. But what is very clear is the builders have lower margins, but they have significantly faster revenue growth. They're actually investing in growth consistently. It's the Bezos mantra, and I don't own Amazon, nor I think it's a dirty word in this business, in this room actually, but it's basically the same mantra. Now, I think one of the reasons between the US and the European outperformance is Europe doesn't give quarterly guidance. And unfortunately, I'm helping someone run for president of the United States, actually, and the consistent feedback she gets from CEOs is like, I want to do the long term. I can't. I'm going to get fired, and the next guy's just going to do the same thing. So unfortunately, it's a game in the US that CEOs have to play, or else they'll be fired. So with that said, I'll give you two examples. It might not be a surprise if you know who I am, but we'll talk about two European builders.